Let's get to the task at hand here. And our agenda for today is just looking briefly at where we sit with the economic picture, because that does have a way of framing asset price opportunities or asset market opportunities over the intermediate term. And then 2023 outlook and beyond, because there are quite a few pivot points that are likely to occur here in 23. We just want to outline what those look like to set some expectations and how we're positioning for that. So let's get started. Moving to the economic update, I think should come as no surprise. The economy has been indicating recessionary conditions for quite some time, as first noted by the yield curve inverting earlier this year, and then a number of other kind of leading indexes, whether it's the Conference Board's leading economic indicator or credit card interest rates, which are reaching new highs. And then we have another one here, which is the ISM services and manufacturing indexes, now firmly in contractionary territory. So just for reference, for those who have not seen this chart before, any number that's below 50 would indicate contraction in either segment of the economy, whether it's services or manufacturing. November to December had a really big noticeable drop in the services section. So what does this mean? It just means that the probability of recession in the next 6 to 9 months is a slightly higher likelihood. Although I did want to mention it's not a foregone conclusion, so we do have to hedge our bet a little bit with relation to how aggressively we want to price in a recession into our outlook. But certainly, I think it's a rising probability, as many markets would suggest. Although, as you'll see in a moment, our positioning really isn't evolving too much from where we exited Q4. The inflation update, this is numbers again through November. We haven't received December numbers yet. Those numbers are actually will be coming tomorrow with the December CPI report. But the point I wanted to make here, and I did show this last time, the point I wanted to make here is that there does remain some very sticky inflation down here in the red bars in the services segment. And primarily what that means is coming through from owner's equivalent rent and rent of the primary residence measures, as well as a few smaller items here and there like medical care and apparel, for some reason are still rising in price. But then notwithstanding, most other components are declining. And so that's generally a good thing. It probably does mean that CPI will be lower than the current level right now, and the headline number of 7.1%. Energy prices are down. Although I would mention energy prices have taken a pretty sizable rebound from middle of December into where we are today. And so, this is why you really do have to look at the longer term trend to establish any sort of certainty with the direction. But, I guess to frame out the outcomes out of tomorrow, if we get a slightly higher inflation reading than the expectation I believe is 6.7%, in December, month over month CPI. If we get a little bit higher number than that, then markets will generally not react very favorably. If it's a little bit lower than that, however, then we should all expect a pretty nice rally, which is one reason I think at the moment as well, while we still are maintaining our target equity positions, because the market is definitely primed and kind of operating on the razor's edge right now. This is that familiar chart that we've shown for a number of different periods, and every time there's an update to the CPI, we'll update this. And remember, about 6 months ago, this chart was showing, or maybe 7 months ago, this chart was showing that CPI would get below 6% on a rolling 12-month average sometime between early Q1, back in this neighborhood. Well, that's not been the case. It's not been allowed to occur with the actual CPI readings that we've received. And so the current time until we get to below this 6% number in inflation, and the headline number is somewhere between June and August. Somewhere. I mean, don't want to be too specific about these things because readings can evolve, but I think the target window is now somewhere between June and August. So again, 6% is a key number because for a number of reasons, and historically that's been significant. to indicate that, when CPI on a rolling 12 goes below 6, coming from a high level down to a lower level, that both stock markets and bond markets tend to respond very positively or favorably. Looking at what we're doing within currency markets, why are we paying attention to this? Well, we actually have had a really sizable move from the middle of 21 up into the latter part of 22. And, it does appear as if this was a kind of a super spike, if you will. More generally, it's migrated back down to this 105 level. And I guess just the reason we want to show this is because these currency movements do have impact on foreign assets, so international stocks, international bonds, and just broader measures of volatility. And I think the reason why we want to pay attention here is that if this chart does, if the dollar index, this is the US dollar index, if it does migrate below, call it, 103 to 100 to 103, then that could signal a trend shift that we'll be watching pretty closely to a weakening dollar, which for those of you that have been following market matters for quite some time would also be a signal for us to maybe increase our exposure to international stocks, international bonds for that matter, if other conditions were met. So this is generally important for something to watch. In addition, another reason we want to watch the dollar index is because the dollar, if it rises too quickly, does constrain pretty massively financial conditions globally. And the fact that it's come off quite a bit actually does help build a case for why markets have improved maybe over the course of Q4 and into Q1. So this will be really also another important indicator to help us assess financial stability and conditions. So not a lot to note there, but it's come off and it's been helpful to markets. I did show this chart once before, but I did just want to reiterate. This shows returns by asset classes over decades. So the pink lines are in the 2000 to 2010 decade. The purple line is 2010 to 2020, and then the green lines are 2020 through Q2, or I'm sorry, through Q3 of 22. And just what I wanted to point out here is that, it is interesting, how we can get anchored into, preferences and heuristics and biases. But I just wanted to point out, that we could be at a point where we start looking more heavily at international stocks or other types of assets like high yield, potentially. And that time, we have to be nimble and willing to look at those things on a go forward basis. And so who knows, the decade of 2020s could be a little bit similar to the pink line because we are coming off of a pretty substantial correction in technology, venture capital, digital assets, and it does have a way of rhyming with a lot of what happened in the 2000s. Commodities are interesting to keep an eye on because would you be surprised to know that actually the price of energy, or energy meaning crude oil, has actually done a complete 180 from or full round trip, if you will. Although now this is all commodities, energy related commodities broadly lumped together. So that's diesel, natural gas, distillates, things of that nature. Over the course of 2022, that basket was up, call it 20% or so. But interestingly, base metals and agricultural products were down in value, even though early in the year they had pretty significant gains. So all that's to say is, commodity markets certainly are pricing the current environment as if, it's going to be business as usual into 2023. And I think there's some risk to the upside for most of these commodities, actually, because of what's going on with supply chains, but also significant underinvestment in weather patterns that are changing pretty dramatically that could lead to some upside. So we definitely have, over the course of 2022, been increasing our commodity-related exposure within a variety of across all of our portfolios, actually, trying to account for that outcome as a possibility. But I guess, my broad thoughts here are maybe we've got some downside to price in and energy in particular, but other commodities. But longer term, the structural outlook for commodities looks pretty positive. Specific to energy, I did just want to point out this was a great chart that Axios put together as of December 9th, but this is a picture of where we sit with the Strategic Petroleum Reserve here in the US. And you can see after peaking out in 2010 over 700 million barrels in the Strategic Reserve, we now find that level well below 400 million, and with a substantial draw over the course of 2022. Biden administration has indicated they'd be filling the Strategic Petroleum Reserve back up at levels below $80 per barrel. So that's, in my opinion, only going to create a bit of a floor under crude oil, particularly in the US, at around that $8 level, because it's common knowledge now that $80 is the level that the administration wants to fill the reserve at, and thus it's no surprise again that crude oil has migrated its way back to 80 here over the last few weeks. And just to touch on where we ended the year, early in the year, I think it was in July or June, I laid out, because there was quite a bit of negative sentiment out there, and I was thinking it was getting too negative. But I outlined what could go right at that point forward, and actually it turns out 3 of the 4 things that I indicated have actually come to pass, and those are I think all positive, because it could lead to further upside in things like equities in particular, as things like inflation come down maybe faster than the expectation and sentiment reverses. And also we did get a little bit of a positive bump with cessation of conflict around the Russian Orthodox Christmas holiday season. Russia declared a ceasefire for a few days. I'm not sure that wasn't strategically timed, because there were lots of indications that they were overextended. The Russian forces were overextended and being, overrun by Ukrainian forces. But that notwithstanding, this could be maybe a plus and a minus at the moment. But we're looking for some things out of the expectation right now that could lead to some further upside. But there are some things that could go right now. So that's the broader economic picture. And how does 2023 look? I mean, these 1-year periods are very difficult to forecast, of course, but at the end of the day, we have to put positions in place, and this section is just meant to help identify where our highest likelihood of positive outcome would be. And this picture, I think, does a good job of maybe visually describing what 2023 is likely to be. That is still swimming against or pushing against the tide, but yet making forward progress. So, the tide, of course, being the Federal Reserve and their interest rate hiking cycle that we are kind of driving the boat into at the moment. But this is the direction we need to go. As far as our investment ratings go, and I've been thinking about, would love to some feedback from clients, but adding some notes off to the side here. But our outlooks for our ratings actually really haven't changed a whole lot since we put these together in Q4. So we're coming into the first quarter here of 23 in relatively a similar position. The composition of these holdings has changed a little bit. At the end of Q4, we did make some moves into some indexes that were mid-cap oriented. So that position is now in place. We are looking at small cap indexes now, because valuation on that front, as I'll show you later, is actually very attractive relative to where history would suggest and what we could own. We still have a bit of an underweight to developed market international stocks and emerging markets in particular. They have rallied, no question, quite nicely since about the middle of December. But I think a lot of that has to do with the relief rally, not really much on any fundamental improvement per se, just sentiment shift. Bonds, this I do want to make the disclosure that we see really no utility for long dated bonds, but still we still don't have any exposure to that through our portfolios. It's really very short term positions or intermediate term positions if they're in the context of mutual funds. But for any neutrals we see here, I would just caveat by saying we're looking at shorter term positions, 1 to 5 year positions across each of these, which we have been pretty active in more recently. Still no exposure to EM or junk debt. And then, alternatives, as one of the slides I'll share with you in just a moment would suggest, as interest rates have risen on the short end, that really is providing a nice tailwind to a lot of alternative strategies that you'll see here in just a moment. I have changed some of these, so it's not the same old talking points here. So just want to go into what these are and what these modifications are. So I'm not trying to get too cute here, but in this first upper left box, we're moving from an era of TINA, of which there is no alternative to stocks, to tapas. That's just how the letters shook out. I promise. To there are plenty of alternatives. Now, not to say that we should action on any of the alternative stocks that we come across, but with bonds rising, bond yields rising, that's creating nice opportunities on the short end of fixed income. It's also creating nice opportunities in things like private markets or even liquid alternative markets that we find attractive, and even in different parts of the equity market. So, but the main point I wanted to make here is that if bond yields, if the Fed does come out and surprise folks and raise rates, 50 basis points this time, maybe another 25 to 50 basis points in 23, later in 23, then you've got a 1 year treasury bond at 5.5%. That's meeting a lot of financial plan returns that would be a really attractive level to convert some of our maybe more expensive positions like alternative positions, liquid alternative positions, into risk-free treasuries. We still are in a bit of no man's land. I mean, this is maybe frustrating for some to hear. I know after a dismal 2022, 2023 continues to be a transition year, and by extension, because of that, you were still going to see a lot of economic volatility, and by extension, price volatility, because not only do we have budgetary issues at the federal level, less so at the state level, but we've also got dynamics where interest rates rising do create budgetary issues or exacerbate budgetary issues. So we'll have to work through those as a country and states, but that will create opportunities that we'll just have to be patient for on the other side. So pin me down. First half of the year is likely to be pretty choppy, followed by a more positive second half of the year. There are, of course, opportunities that are on the horizon in that second half of the year, and that would give us opportunities if prices were to move a little bit lower in certain categories to add to areas where you have no exposure right now. So prices going down actually should be looked at as a good thing in some cases, and we would welcome the opportunity to buy things like high yield bonds at a 9 or a 10% yield versus where they currently are at maybe 7.5. That's just not enough compensation for the default risk at the moment. And actually, to that point, REITs are one of those things that actually had a really difficult go last year, as you'll see here, down 29%. That's certainly getting a little bit closer to the levels that we would find maybe attractive to add to the portfolio, but still not quite there yet. And I think the final piece that we just want to point out here is that, living with higher inflation levels than we came from pre-COVID, I think is just going to be the norm. And what does that mean? Well, it means that valuation multiples on most assets will be a little bit lower than they were coming into COVID. And it does mean that there's probably going to be a little bit more economic volatility with inflation at a higher level. Going to the yield piece, this is a comparison of where we stood March of 22 versus where we stood at the end of the year, yield level wise. Interestingly, stocks, even though they went down in value, the yield didn't really change very much, just because it does take quite a bit to shift when you're coming from very low levels of price movement to shift this yield in any direction for the dividend aristocrats index. But notice what's happened here on the higher yielding side of the portfolio or the equation. You had coming into the year, investment grade corporate bonds started off the year at call it 3.25%, ending the year at a 5.12% yield. So this is really for the longer side of things, of course, but noticeable that this is just what I mean by the opportunity set has improved pretty meaningfully. And we definitely want to make sure we're looking across the spectrum to see where we can add things and where we shouldn't be looking. But by and large, these are getting to levels that maybe at the next Market Matters, I'll indicate where we would be considering these for inclusion as a bar that's purple or something. And the year-to-date picture for stocks, you can just see, again, referencing that this was a pretty ugly time for markets with the S&P down close to 20% for the year. International markets, broad international developed markets actually performed a little bit better thanks to a very significant move in the last 2 weeks of the year to end the year down 16.5%. So outperforming the S&P. That hasn't happened very often, so we want to make sure we're noting that. Small cap index is down 21%, so down worse than the S&P, but that's helpful to our reasoning as to why we might want to consider these. And then the big one to keep an eye on here is the Chinese market, because that had a very visceral sell-off, almost down 45% for the Chinese large cap index at one point in 2022, only to rally back 20% in the last quarter as COVID lockdown procedures were eased. President Xi was reelected for another 5-year term, and loosening restrictions on the property market all led to a sizable upshift in Chinese stocks. And these tend to be leading of developed markets. So we think it's really positive, actually, that Chinese market was up in Q4, because that could be indicating that the worst is behind us. Just showing one reason, again, why we think 22 might be sort of a bottom for where we found both stocks and bonds over the next few years. This chart shows you, I got off Bloomberg, so apologies for the fuzziness, but going back to 2000, it shows you the dollars lost globally in both stocks and bonds. And you can see here, back in the dot-com bust, roughly $10 trillion of value is lost at the nadir of this drawdown period. In the financial crisis, we got down to about 22 trillion or so, 23 trillion in wealth lost due to that drawdown. And more recently, one reason why we think 2022 is likely not to be repeated is because just the loss of wealth was so substantial at greater than 35 trillion globally. So it would be a very rare situation that this would be repeated. And so maybe, this choppy market in Q1, Q2 is not going to be too much worse than where we are, end of the year at, potentially paving the way for brighter pastures in Q3, Q4. Just looking at, where the sources of return came from in 2022, you can see it was a pretty substantial. So just to orient you, the blue line is earnings growth. So in 2021, earnings grew 50%. The black line is the change in the PE ratio. So you can see, again, 2021, PE ratio shrank by 15% or so to end up for a total return on the S&P of a little bit right around 30% or so. This year, however, was a bit different. Earnings growth will come in somewhere around 5 to 7%. This is, of course, being offset by more than 20% decline in the earnings multiple of the index, so that stocks settled down roughly 20%. Again, even over this short period of time, this is not likely going to be repeated. Some other positive things to note for 23 and why we think the back half will be a pretty good, possibly a good year, is that this is a chart I found from FundStrat, run by Tom Lee. He does tend to be a perma bull, but I think it's an interesting data series nonetheless. So going back to 1987, what he found was, if you look at every year where there was a negative return in the high yield bond market, which can actually be a proxy for, or a loose proxy for, the equity markets, given the tentativeness of the companies that are in that index. And almost every year that there was a drawdown, the following year for markets was positive. And you can see he summed up all these returns here on the right. And so interestingly, in years where the high yield market was down, in the years thereafter on the S&P, the average return was 22%. So, I don't think necessarily 22% is in the cards for 2023 per se, but certainly a positive return nonetheless would be a welcome addition for this year. Just a note here that markets are a little bit on the expensive side. So we still get to receive in Q4 earnings for the S&P. So we'll see where this actually shakes out. But according to Goldman, we've got about we're coming to the end of the year, roughly in the 18 to 19 times earnings. You can see where we ended 21 was at 21 times earnings. And their estimate is that it's going to only decline to about 17 times on the S&P. And this is next 12 months. This is not forward PE. That can be a bit of a difference. And this is the chart I wanted to show you earlier as to why our opportunity set is now migrating into the smaller companies outside of large cap. And so what you see here is the 12/31 value for each of these asset categories in the equity side of the trailing 12-month price to earnings ratio. And so you can see the S&P ended 12/31 at 18 times earnings. I'm sorry, at 16.65 or 17, call it. The average 20-year forward PE, which includes estimates for growth for the next year, is roughly 15.5 times. So these are always different between trailing 12 and forward PE. But needless to say, the S&P still trades a little bit rich to its 20-year average valuation. And S&P value is trading, quite a bit above. International stocks are a little bit below their long-term average. Developed markets are, but this can be obscured by very cheap markets like Japan, and more expensive markets like the German DAX or Switzerland for that matter. Emerging markets incidentally aren't very cheap relative to the long-term average. So again, we feel no reason to necessarily step into emerging markets right now because they are just objectively not cheap. But where we have stepped in more recently has been core mid-cap. So we added a S&P mid-cap index across most of our strategies on the benchmark-oriented strategies. And we have on our single stock strategy added slightly smaller companies across the board. And then, interestingly, I said small cap was making its way to the research queue. And you can see here, S&P 600 small cap index is actually trading only 74% of its long-term valuation average. So certainly I think this should help orient our research agenda, these bars down here. And I think this is why we are arriving at the positions that we are at the moment for further look. Fixed income, again, not, and many of us, hardly any that I have read, forecasted such a negative year for fixed income, especially when you consider long bonds, of which we own none, of course, but the long bond ended up the year down by, call it 33%, or down by a third from where it started. That is orders of magnitude worse than the most recent worst return in the 70s, which was, I think, down in the low 20s. But the best performing asset class was municipal bonds for the year. Interestingly enough, they might have various reasons for that, but I think a lot of it has to do with the better supply and demand dynamics within the state, fiscal levels, not needing as much capital due to strong tax receipts versus maybe any higher quality than maybe government bonds or something like that. But again, a poor showing for high yield and emerging market debt. So again, good that we didn't own those things, but not to say we shouldn't own them ever. It's just something we didn't own for a variety of reasons. But now that we're getting to levels that might be attractive, well, they certainly are rising the research agenda. Where are we with the yield curve? It's just, we're staying right up in here in the short-term part of the yield curve. Certainly, so what this chart shows you is at various quarters. So Q1 was the blue line, Q2 is the yield curve of the red line here, Q3 is in green, Q4 is where we ended the year. I'm sorry, Q3 is where we ended in the purple line. And then Q4 roughly is where we ended up right here with these guys. So you can see where we're staying and where I've indicated we're going to be from a positioning standpoint. It's not necessarily in this very short term, because this is like money market type investments, but really it's in this, call it 6 to 2 year window, where you can get, you know, yields definitively above 4%, is where we're continuing to find attractive opportunities, not only in the government bond market, but also investment grade bond market. And one thing I would note about the bond market and why 2023 is a transition year is because this is there's a big dissonance right now in the bond market that needs to be reconciled. So what's that dissonance? Well, you can see the Fed dot plots are here in green. So this is the average of what the Fed governors think the Fed funds will be at these points in time. So at the end of December of 23, most feel that the dots, or the Fed funds rate, is going to be a little bit above 5%. At the end of 24, it's going to be a little bit above 4, you know, so on and so forth. But the market, which is this orange line, believes a very different picture. It believes that in 23, at the end of the year, the Fed funds rate will be much lower, call it 4% versus 5.2. And in 24, you're looking at 3 versus 4.25. So these are big dissonant viewpoints that have to be reconciled, which is why I was saying, you know, it's likely going to be a pretty big transition year, because one of these is wrong, right? We don't know exactly which one, when we have our own ideas, of course, Fed versus the market. It is possible the Fed could thread the needle, but I think it's to a soft landing, but I think it's increasingly unlikely, and that therefore one of these is going to be wrong. So we would rather not take much risk in the bond market at the moment, staying short term and wait and see how this evolves as they hike rates into 2023. Then finally, turning to the alternative markets, there's a lot of action here as well during 22. You can see the commodity markets ending the year, call it 17% or so. Gold, interestingly, held up really well, basically flat on the year, when both the stock market and the bond market were decidedly lower, and that certainly shouldn't go unnoticed. So you may recall, if you've been around a client for a while, we did own gold for a brief period in 2013 and 14, has since exited. That was certainly the right answer to do it at that point. But it's starting to pop back up on our research agenda again as a position to maybe warrant inclusion in small part, just to be that hedge against, you know, kind of the financial system issues that might crop up with this rate regime. As I mentioned, real estate, this is the VNQ ETF, was down almost 28%, which is really fascinating, because the properties, as you'll see on the next slide, did not decline in value that much. And then Bitcoin, proxy for, you know, speculation potentially, or longer term speculation, was down 65% for the year, which I think this is a really good dynamic to have a lot of the speculation come out of these riskier assets, because it just provides a more solid footing on which to launch into you know, future positive returns for mainline asset classes. But we'll be watching Bitcoin, because it is, and other digital assets, because it does tend to be a leading indicator for other markets, just like China, from what I was mentioning earlier. And so any discernible uptick in Bitcoin would certainly, I think, lead to potentially positive moves in equity market. And then finally, we can actually skip that page. This is just that appraisal index that I was showing you. We do note that you know, there are some issues right now with some less liquid real estate vehicles, among them BREIT, which is Blackstone's interval fund REIT structure, as well as Starwood. Those have both put up gates for liquidity, so that meaning that people will not be able to receive all their capital out. And so what is that going to do to the property markets? Because they've been one of the biggest incremental buyers of property here over the last couple of years. We'll have to just wait and see, but I think it just means further pressure until that redemption wave works its way through commercial real estate. And then finally, just before we conclude here, I would note that, I showed this, I think, in a 2 minutes podcast, but this is a great chart that BlackRock put together, showing when and how the return profile improves for liquid alternative strategies at different levels of cash. So for levels of cash that's below a 0.5% yield, you can see the average return as calculated by BlackRock and these indexes is coalesces around between 6 and 7. However, when cash rates get above 2, which they currently are now, the return profile for a lot of these strategies gets much, much better and much more broad. So, we've added macro strategies to our liquids bucket over the last 6 months, as well as some event-driven strategies. So we feel like we're in a pretty good spot with regard to that. And even though our alternative sleeve didn't have a positive return, it was much better than the equity markets and bond markets. And so we think we can build on that for 2023. This is just a summary of our investment committee changes. I won't go through all these, but just one note more recently is that towards the end of October into early December, we did make some pretty meaningful changes in our bond portfolio, getting our bond portfolio even more short duration in October. And then we did make some shifts to our core equity strategies related to mid-cap and transitioning a lot of active mutual funds into ETFs. And then I know I've sent a lot your way, so if there are any questions out there, feel free to lob those into the chat. That'd be great. I'll try to address them as they come in. But here are just some key takeaways that may look familiar, but some differences as well. So we still remain stocks over bonds, even though bonds did go down in value. The starting point still needs to be maybe a little more attractive to have a more meaningful weighting to bonds in the portfolio. So stocks having gone down to the level they have, and with opportunities showing up in different areas, lead us to believe that there's still lots of work to be done within that segment of the portfolio. And just as a reference, we'd be looking for a short-term, bond yields to creep up to 5.5 or so, maybe 5.75 to make any sort of meaningful shift into bonds backed from alternatives or stocks. I think we are looking for this regime shift in both the dollar and the growth value dynamic, which is really going to drive some portfolio shifts or portfolio changes. It hasn't quite happened yet. We've only seen 1 year of the growth value dynamic reversing, and the dollar is still kind of waffling around these higher levels that it's moved up to. But if that does shift, those two things alone would have pretty meaningful consequences for our strategies. Alternatives over bonds, I just showed you the return profile is increased pretty nicely from where we started the year in 22. And then, ultra short-term bonds versus money markets still make quite a bit of sense, because money markets are yielding, call it that 3 to 4% range in some cases, whereas, a 6-month, 9-month treasury, you're now at, 4.6, maybe 4.8%. So lots to do on that front. Thanks, everybody. Thanks for tuning in. We'll talk to you soon.